Well,
Great.
thank you, Simon. And yes, as a matter of fact, since 2003, we've had a relationship with your organization. And your organization, both directly and indirectly, has been very helpful to Online Trading Academy's growth and expansion. I'll talk a little bit about the history of the company, but when I get to that section, I'll put a footnote in on what a wonderful relationship we've had with your organization since 2003. And you've touched a lot of lives. I know you've touched a lot of lives in your own work, but the relationship you've had with Online Trading Academy, since you were the genesis for us to have a presence in London and St. Albans and other markets in Europe, you've indirectly through Online Trading Academy touched many, many, many more lives. And I compliment and support the work you're doing, because to teach people and motivate people to take responsibility for their own financial affairs, I believe is very important. Simon, I don't know if you know this or not, but at the end of July, we hosted in Las Vegas an event with over 700 graduates of Online Trading Academy, what we call the OTA Thrive event in Las Vegas. And we're going to be doing it annually, and we expect it to become a very, very large event, getting together our community of users from all over the world. And we had graduates there from about 40 states of the Union and about 17 different foreign countries. And so, believe it or not, any foreign exposure was, I would say, indirectly stimulated by our relationship with your organization over the last,
Fantastic.
14, 15 years.
That was like a great,
So
great event. Yeah.
it was an incredible event. It was a 3-day event, and it was, the energy was just over the top. As a matter of fact, if you go to our website, if you go to our Facebook page at Online Trading Academy, you go to our Twitter page at Online Trading Academy, there's lots of videos that have been posted from various events there. Just look for, you can do a YouTube search under Online Trading Academy Thrive, and you'll see what some of those experiences were about. They were a lot of fun. But yes, Online Trading Academy was formed in 1997, so this event in Las Vegas was our 20th anniversary. We have about 250,000 members that use our resources on a regular basis, and I'm very proud of our organization. We started out as a day trading broker-dealer archive in July of '97. The founder of the company is my partner, A.L. Shahar. I joined the team in first quarter of '98. So we've built an incredible team and organization of users. I'm very proud, of that team we've built. Matter of fact, I'm getting a computer starting to freeze up a little bit for me here. But there we go. We now have about 41 fiscal centers spread over 7 countries, and we are, I would guess, the largest trading and investing education service in the world today. And we are a primary outsource solution for multiple financial institutions like NASDAQ, the New York Stock Exchange, Chicago Merc, Bombay Stock Exchange, Indonesian Stock Exchange, and multiple others. We also affiliate and partner with and supply education for multiple broker-dealers. 2 of our favorites are Oanda, which I know you all are familiar with in the UK, and a firm I hope you're familiar with, which is a premier broker-dealer named TradeStation. We're not a broker-dealer. We're a for-profit education company. We sold our brokerage firm, believe it or not, 2 weeks before 9/11, and converted our business model into what we have today, which is pure education. And we host courses and techniques using a patented course strategy I'll talk about in a moment that gives our users high probability turning points in the market. In the years I've been engaged in this business, and I've been engaged in the markets as a direct participant since late 1960s. So I've seen a lot of, yes, economic variables, go through the world, and I've participated in a lot of those crazy periods of time we'll look at in just a moment. But these are the common mistakes that we have found that the novice traders seem to make. Assuming you are a novice trader as a member of this webinar, your pattern of engagement is remarkably different than those of professional traders. Professional traders have a completely different method of engagement to source opportunities, to make decisions that are disciplined and decisive. And in order for you to transform your trading results that I know all of you want, we have discovered that there are 9 mistakes that the trader makes. And I can also make the claim that buy and hold investors also make these same conscious or subconscious errors. So here's what we have found, and I'm not going to go into depth on each one of these, but you know that who some of these are. You've heard them before. Every trading book seems to outline them. And I'm going to show you a solution. So the first thing I want to do today is define the problem. The problem we have found are really these 9 issues. Number one, novices really don't understand prudently how to use leverage assets. Some of the leveraged assets like Forex and futures give you an insane amount of leverage that if you're not properly trained to use it, it's like having too much horsepower in an automobile. You may have driving skills to a certain level, but do you really have the skills to handle the horsepower in a Formula One race car? The answer is no, and it takes some training and coaching. You're not going to get in a Formula One race, and you're just going to be at such a disadvantage. You might even, cause some permanent damage, not only to yourself but fellow racers. The other problem we think that's a real problem is the novices are spending too much time listening to the media. We have discovered in the United States, I would guess it's not a lot different in the UK, that the novices really don't understand the opportunities to institute short selling strategies. We are not a big fan of traditional technical analysis of the likes of stochastics, MACDs, moving averages, Bollinger Bands, etc. So we don't use traditional technical analysis. I'll show you what we do use, but we basically have pretty much abandoned the use of traditional technical studies. Most novices traders are not aware how to identify a market trap. Market traps are generally set by market makers. They're very identifiable on a price chart when using our core strategy, which I'm going to give you samples of today. And unfortunately, the novice trader under rule number 6 is not putting their stop in the right location. Now, I'm asked all the time, I'm told all the time when I do seminars, I'm told that by the public, the novices, that they don't like to use stop losses. And I ask why, and they say, well, I get stopped out too frequently. And my retort to that is, well, perhaps you're putting your stop in the wrong location. There is a decisive, disciplined way to use stops, and it's not some arbitrary percentage that you read in a trading book or saw in a YouTube video. And unfortunately, under rule number 7, we have discovered that novice traders really have no simple rule-based strategy to make a buy or sell decision, which should be of high probability turning point in the market. I'm going to show you what we use. And unfortunately, under rule number 8, the public does not really understand the power of market timing. And unfortunately, the general public is guessing, if the truth be known. And sometimes it's an informed guess, sometimes, excuse me, sometimes it's an educated guess. But I'm going to show you that we have a very powerful rule-based market timing strategy that we follow rigorously in a decisive, disciplined way. And of course, not having a rule-based strategy to follow, simply guessing in an inconsistent way, is not really going to give you the probability of where price is going to turn. So at the end of the day, what are we going to do about all this? Well, we have to adapt. We have discovered that adapting is very important. A lot of people get seduced by institutional financial news on CNBC, Bloomberg, and other resources, perhaps like the FT in your world, is that they're seduced by the concept that buy and hold works, assuming that it's really a lazy man's way to riches. In fact, it's not. If you take a look at the S&P, yes, there have been periods of time where buy and hold worked quite well. That one period of time specifically that I'm very conscious of was the period as measured by the S&P between 1980 and 2000. You didn't need to be in that particular period of time of 242 months. We saw the nominal price move 1,380%. And you didn't need to be well educated in an environment like that, and buy and hold, quite frankly, worked pretty well. But this is the environment we live in today. This is the market between 2000 and 2017. Now, we've seen, if you go from that peak in 2000 to approximately where we are today, as measured by the nominal S&P, we're up about 53%. That's maybe approximately 3% without adjustment for any inflation or erosion of purchasing power of the currency unit. But does buy and hold work in a market like this? Well, not too well. We saw over a 45% decline between 2000 and 2002. We saw a 56% decline between 2007 into March of 2009. Now, we've had a nice rally in the market since the bottom of the market of March of 2009, but your pension plan was ravaged in the bear markets pointed out on the screen. But since March of 2009, the markets, as measured by the S&P, has been up over 250%. And my question to you and your listeners and viewers is, how many of you have a mutual fund that's up 260%? I would doubt very few of you do. And part of the problem with the whole mutual fund as a category, and we're not big fans of the mutual funds at all, simply because their administrative fees are too expensive. I don't know what your administrative fees are in the UK, but in the United States, most mutual funds on average have a 2% fee per annum. That will consume a substantial percentage of your capital gain over time. So we don't use mutual funds. Our advocacy is you use exchange traded funds, simply because they do give you broad exposure, they give you full transparency, and their administrative fee is 1/10 to 1/20th of that of the average mutual fund. So we are an advocate that investors for their pension or for traders stay away from mutual funds and learn how to time these markets in periods where it's appropriate. Now, what do I mean by that? If you go back to December of 1989, going forward, you can see during this period of time laid out on this grid that we have had multiple bull and bear markets. I don't have time to go through all of these, but you see these bull markets have ranged anywhere from a 48%, 50%, 60% correction marked in red in the third column. The fourth column gives you the number of months that bear market ran, and the next column on the right gives you the percentage decline from the top. But let's take a look at the green third columns, where we had gains, substantial gains from anywhere from 34% gains to 135% gains in bull market periods of time. You can see very clearly in the fourth column that the bull markets have historically been much longer than the bear markets. But the bear markets do come along. On average, if you go back and look at the historical data, they seem to come along about once every 7 years on average. Now, this bull market that we're in right now started in 2009. It is the third longest bull market on record. And at the end of the day, it's been an outstanding bull market. But at the end of the day, what this table shows us is historically the market has transitioned from a period of oversold to a period of overbought. Now, that in my mind tells me that I need to think and act more from a trader risk manager's perspective. I think this table alone destroys the financial professionals out there that are advocating that you be a buy and hold investor. It's very clear that we go through periods of time of alternating bull and bear markets, and they can run for a substantial period of time, or in some cases they can be very short corrections. I am convinced that we are due for a substantial correction from this at or near bull market peak that we're at right now. So let's talk about the Online Trading Academy solutions. The Online Trading Academy solutions, which have been documented to solve those 9 headwind challenges, are based in what we call our core strategy. Online Trading Academy, through the leadership of Sam Seiden, who's very well known in the trading industry, has developed a core strategy that has been patented. Our patent was issued by the U.S. Patent Office February 11th, 2014. This is an image of the patent. And at the end of the day, it is based on a unique methodology to discover high probability turning points in the market that I'm going to show you today. I'm going to show you the results of some trades using our core strategy, because to my knowledge, and I haven't done an exhaustive patent search, but I don't know of any other core trading strategy that has been patented by any intellectual property authority in any country. So I'm going to say, for the sake of this webinar at any rate, until proven otherwise, this very well may be the only patented core trading strategy in the world. And what's unique about it, it's not based on filled orders. It's based on the location, the identification on a price chart of where are the high probability unfilled orders that are sitting on the institution's books to be filled at some point in time. Because it's the unfilled orders you're going to see, and what I'm going to show you today in defining our core strategy, that is really the information that you need to determine the high probability turning points in the market. And I'll show you why that is the case. So at Online Trading Academy, we're really looking at 2 groups that are engaged. We're looking at the retail participation in the United States. That's about 100 million households in the United States, directly or indirectly, have exposure to the equity markets. And it's also the participation pattern of the financial institutions, the likes of Barclays, UBS, Goldman Sachs, Merrill Lynch, etc. Evidence suggests that the institutions are wildly profitable. Why are they wildly profitable? We'll talk about that in just a moment. Information seems to suggest that the buy and hold public and the general public are not doing very well in the capital markets and have woefully underperformed the S&P. As a matter of fact, you will discover, if you take the time to do a little bit of research, that the S&P 500 index, that is not an actively managed portfolio, has outperformed over the last 3 decades 95% of the active managed mutual funds. So the Wall Street professionals have not done a good job of managing the public's money. And therefore, I think that you can do as good or better a job of managing your own money than the financial professionals. So let's talk about the history of our core strategy. Our core strategy was developed by Sam Seiden on the floor of the Chicago Mercantile Exchange. And basically, Sam was hired not as a trader, but to be a clerk on the floor of the Chicago Mercantile Exchange many years ago, to be as an employee to run a professional trade desk where professional order flow was routed to his desk, retail order flow was routed to a different desk, but he became an expert, a specialist in the administration of institutional order flow. Now his job was to give some semblance of order to the orders, the buy and sell orders that came to his desk. So the image you're looking at here, let's assume this is Sam's desk. There was a big security barrier around it. Traders were always walking by trying to peer on his desk to see what the order flow looked like. Now these are all aspirational orders from buyers and sellers of institutional quality and size, the likes of Goldman Sachs, UBS, Barclays, etc. The green stacks of orders represent buy orders. The red stacks of orders represent aspirational sell orders. Notice that the stacks of orders, their size represents the quantity. The price under each stack of orders represents the price. Recognize there's more buyers at $10 than there are buyers at $40 a unit. The red stack of orders represent the institutional aspirational sellers. These are wannabe sellers that desire to find a counterparty to be the other side of their selling decision. Now we don't know why they want to sell, and we don't know why the other side in green wants to buy. All we have in front of Sam's desk at this moment in time is their demand or their supply, and we'll talk about that in just a moment. We would call buy orders demand. We would call the sell orders supply. So at the end of the day, note that the sell orders also have different quantities for sale at different price points. Now one day, metaphorically, the wind comes through the Chicago Mercantile Exchange and blows all the aspirational buy and sell orders off into the floor. And what we ended up with in front of Sam was a price chart, a candlestick price chart. And as Sam looked at this, his thought was, well, the candles represent filled orders, and the aspirational unfilled orders are on the floor in this particular example. So he started to focus on looking at candlestick price charts and how do you identify the high probability turning point on a trade which are going to be energized by the action of the unfilled orders. As they get filled, they will become the next tick on the price chart. So our core strategy is based on the simple but elegant principle that there are two kinds of orders: unfilled orders that aspirationally want to become filled orders. And once an unfilled order becomes a filled order, it becomes the next tick on the candle. Does that make sense to you? Well, it made sense to me when it was first explained to me, because what I need to be looking for is where are the unfilled orders? Because once an unfilled order becomes a filled order, in essence, it becomes impotent. That is, of the two orders that are available to us as information, it's only the unfilled order that has the power, the muscle, to move price and create the next price change. The filled order is complete. It found its counterparty. Therefore, it has now become impotent. So let's take a look at this chart in front of us. Note that we've seen a rapid movement of price on the left as measured by this demand zone. Once we see this pattern here on the left and we see the emergence of these three large candles that were created as the unfilled orders became filled orders, we see that there's been a price volatility. How do we know that price has moved quickly out of that zone? By the length of the candle. Remember, each candle represents the same increment of time. In this particular example, each candle represents 5 minutes of time. We'll look at some other trades here in a moment that represent other increments of time, but our core strategy uses one basic core strategy regardless of the increment of time. Now let's assume that prices move quickly. Sam explained the methodology to me this way, and I think it can make a lot of sense for you to understand why our core strategy works so well. let's assume when in the yellow area here on the left that there were many trades taking place, but there was a very narrow average true range. The range of price movement as measured in the yellow area was the distance between that proximal and distal line. The proximal line is the line at the top. The distal line is the line on the bottom. And let's assume there were trades were going along. This is a high volume transaction, and hundreds of thousands of units are getting exchanged. Buyers are shaking hands with sellers. But all of a sudden, and let's assume an institution wants to buy hypothetically 1 million shares somewhere within this demand zone here on the left, and he's received an order from an insurance company to buy 1 million shares of Acme. Well, let's assume the intermediary broker is getting the client's order filled, and let's assume he gets about 300,000 shares filled of the 1 million share order, and then all of a sudden perhaps a news announcement comes along and moves price quickly out of that zone. And all of a sudden, price has now moved to an extreme where this intermediary can no longer get the client's order filled because the client doesn't want to buy at a higher price. The client has given the institution a very specific price range, which is probably somewhere between these two lines, where they wanted to get over time their order filled. But the institution wasn't able to get but 30% of the order filled, 300,000 shares. Price moves away. What Sam discovered in running this professional trade desk is that institutions do something different than novices. Institutions do not chase price. Novices do. It's intuitive to chase price and momentum. Institutions are extremely patient, and they're going to wait patiently for a retest. And assuming there is a retest back to the demand zone here on the right, the institutions are going to go ahead and start buying as price comes back into the demand zone. And that is part and parcel of the core strategy. So what lives in that demand zone? Well, what lives in that demand zone in this particular example, if 300,000 units got filled, there's another 700,000 units to be purchased if and when price comes back down to this zone here on the right. And that's exactly what happens on a daily basis, especially when we have volatile markets. So at the end of the day, Online Trading Academy publishes a service. And what our service is every day is to look at 38 different financial instruments that trade on equity markets and derivative markets, and we publish the location of the high probability turning points where the stacks of unfilled orders reside. So on this particular image, what you see are 3 levels of supply, and each price represents where to draw the proximal and distal line. And then the green area here at the bottom represents 3 levels of demand. Now, keep in mind as we draw these levels out, all they really represent are the stacks of unfilled orders that are yet to be filled in high probability once price retests either the supply or the demand zone. So if someone wants to use our Mastermind Supply and Demand Grid, there is a service available at Online Trading Academy to facilitate your choice. We can either teach you how to draw these levels using the scoring methodology that we have patented, or you can use our service where we will identify the high probability turning points in the market before they actually get to those price levels. Now let me give you another example of how this might work and make an analogy to how the retail market works in the merchandising retail space at your favorite electronics retailer. On the left, we're looking at a price chart of the euro-dollar pair. We have seen that these big green candles have formed here on the left. This is the price of the euro, and we've seen trading against the dollar. We've seen that the price level has moved quickly, indicating to us, we draw our yellow box, we draw forward in time our proximal and distal line, and we are assuming with high probability that this price moved away so quickly, as evidenced by these three expanded range green candles, that there are unfilled orders of professionals in this demand zone. And we are patiently waiting for price to come back and retest the demand zone, where we're going to be a buyer, because we believe that there's support there that will arrest the fall in price here on the right, as evidenced by the red candles. Now note that at this moment in time where we have the circle, price is coming back to touch our proximal line. We know where our distal line is, and there are three rules that we will teach you on where to draw those two lines. Sometimes they're inclusive of the wicks. Sometimes they are not inclusive of the wicks, and we have some techniques to get that done as well. But notice in our footnotes here that price is crashing. The news is probably bad. And the public, the novice trader, is not going to have an appetite to buy in the face of a declining price, in the face of 5 consecutive red candles. The novice is not going to have the courage to purchase. But yet, if this were the price of a flat screen TV at your favorite electronics retailer, and if he were to have a big sale, 50% off, you're going to be a motivated buyer because price is cheap. I believe that when it comes to decisions of consumption, people want to buy products that are on sale. But when it comes to products, financial products, where speculation is involved, when there is a declining price like the euro, the public or the novice cowers in fear. But isn't that really the best time to buy? Yes. What we want to do is buy wholesale at a wholesale inexpensive price and then sell retail. So what happens on this particular trade? Well, price comes down to our proximal line. We do get the retest. By the way, what would we do if we did not get the retest? Well, if we didn't get the retest back to the demand zone, we would not buy. We would just move on to a different trading opportunity. We made about $600 profit on this trade in about 30 minutes in the euro. And I don't know about you, but to earn about $600 in 30 minutes, this particular trade probably took about $1,500 a margin to control this trade. And to earn about $600 on $1,500 a margin is an outstanding return on capital on an annualized basis. And I don't know about you and what the cost of your electronics are in your neighborhood, but $600 will buy me a very nice flat screen TV at my local retailer. So at the end of the day, high probability turning points like the one we just looked at are very valuable. Now let's talk about stop losses. The beauty of our trading methodology, by identifying before we get to the supplier demand zone, is that by drawing the proximal and distal line in the right location using our patented strategy, it tells us where to get in the trade, and it tells us where to place our stop loss. I'm going to place my stop loss on this trade a skosh below the distal line. The distal line is the bottom of the two lines. Now, if there are no unfilled orders in that zone, price is going to blow through and trigger my stop. But that's okay, because I have predefined by both price and size how much I'm willing to risk on this decision. The beauty of the Online Trading Academy methodology that our students love the most is our methodology tells us before the market turns in high probability where to get in the trade, where to enter the trade, where to exit the trade with a small loss, and where to have a target to exit the trade with a winner. Our methodology involves taking 1 unit of risk for a minimum of 3 units of reward. And if I do that on a regular basis, I'm probably going to have a pretty good trading month. So who are these banks and institutions? Well, these banks and institutions that participate in the market are people that you probably do business with every day. These are major financial institutions across the world that vend products and services that make our life better. So what we want to do is teach our clients to think and act more like the institutional pattern of behavior. And trust me, I've been in the institutional side of this business for over 20 years. I help build and run our trading floor there and here in Irvine, California, where we had 180 traders executing over $500 million a day of trades. Half of them were using our capital, half of them were using their own capital. But at the end of the day, the pattern of engagement is much, much different on the institutional side of the business than the retail novice side of the business. Let's take a look at some evidence of that fact. If you take a look at the institutional behavior of Goldman Sachs, this is what's known as their VAR report, the Value at Risk report. It's published every year in their 10K. You can get a copy of it at edgar.com if you want to see a copy of it, or it's edgar.gov. I forget the exact URL. In this particular year, they had 224 profitable trading days and only 28 losing days. If you take a look at Goldman Sachs, Morgan Stanley, Bank of America, Barclays Bank, UBS, etc., they have an outstanding track record of generating the vast majority of their income in their backroom trading behavior. Now, they're either on an agency basis or on a principal basis. That's where they're making their money. In this particular case, Bloomberg reported in this particular quarter, Goldman Sachs generated about 57% of their revenue. You can see Morgan Stanley only had 4 trading losing days. They reported, and Bank of America in this particular quarter had virtually no losing days in their trading portfolio. So trading is very, very important to these organizations. And I also would say that trading is very important to the liquidity of the capital markets. People seem to forget that you can't have capitalism without capital. And capital means that there are opportunities for liquidity for you and I to get in and out of trades. Now let's talk about the value report of Goldman Sachs and their behavior versus the novices. Take a look here at the bottom. Notice that when the market is falling, as represented by these red arrows on the bottom in 2 particular time frames, what's the public doing? Well, the public's cowering in fear. The 2 biggest mistakes that Sam identified in novice behavior is that the public loves to buy after a rally in price into what we call a supply zone, which we'll talk about in a moment, and they love to sell in fear after a decline in price in what we call a demand zone. So unfortunately, financial media, which we'll talk about in just a moment, seem to want to motivate and stimulate that novice behavior. So at the end of the day, let's take a look at what the professionals are doing. Take a look at what Goldman Sachs is doing. Here on the left, when the novices are selling in fear, Goldman Sachs, through their behavior, is stepping up their value at risk from 100 million to 150 million to be the other side of the fearful selling public. On the other hand, here on the right, when the S&P is declining and the novices are selling in fear, look what Goldman Sachs is doing. They're bumping up their exposure from 90 million to 170 million to be the other side of the fearful selling public. Let me give you some other examples of using these supply and demand zones and not being seduced by Wall Street news events. When we talk about supply and demand and institutional behavior versus novice behavior, I want to make the analogy that Barclays Bank, Goldman Sachs, Morgan Stanley, UBS are really no different in their behavior than any merchant like Walmart or Costco or any large merchant. Merchandising has been around probably since ancient Mesopotamia. How do merchants make money? Well, they buy wholesale, they sell retail. And if they do it in significant volume with discipline, they're going to be a very successful retailer. I would posit that Goldman Sachs and the financial institutions are retailers as well. They focus on buying wholesale in what we call a demand zone. They focus on selling retail on what we call a supply zone. Let me give you an example of a Microsoft trade. And this is a real trade that goes from June of 2014 into February, March of 2015. This is a real transaction. Came right out of our trading room. In this particular case here on the left, notice that prices have risen at an accelerated pace, especially as evidenced by this big green expanded range candle. At the end of the day, when I see this pattern here on the left form, I'm not trying to make money. This is the trade setup. So I'm not trying to make money off this initial move. But when I see this pattern form, and I'm going to draw two lines using our 10 rule-based formula, I'm going to draw two lines, one a proximal line here at the bottom and a distal line below it. And I'm going to draw them forward in time, as you can see on this particular chart. Notice that as price has left this demand zone, it's rallied up to a supply zone. As it rallies into this supply zone, there must have been some unfilled orders in this supply zone left from a previous era, because once price gets into that supply zone, note that it sharply sells away from the supply zone marked at the top. When I see that supply zone at the top, I'm also going to draw those two lines forward in time to identify the supply zone. So now I have on my trade a high probability demand zone here at the bottom and a high probability supply zone at the top that has been identified because of price behavior. Not because of news, but because of the way the candles have formed per our core strategy. Now let's take a look at where price is right now. Where price is right now is right here on the hard right edge. We see that Microsoft has sales have plunged 10%. So here we are in February of 2015. They're identifying a poor quarter. Notice we have a gap in price. Notice that the news has become quite negative. What else is taking place? In the face of the news, with the price down here at the lower right-hand corner, we see that the analysts are now giving it a downgrade and the downtrend. So what are these three messages from Wall Street telling us? We have a downtrend, we have a downgrade from a prominent analyst, and the news is bad. So what is the public getting cues to do? Well, the public is getting a cue to sell. But where are you selling? The public is this really the time to sell? No, you're selling it at a wholesale price that historically OTA has defined as a demand zone. So let's see what happens. So we go ahead, we get in the trade as an online trading academy graduate. We're going to buy the shares of Microsoft from a novice trader who's selling to us in fear because of those three cues they've gotten from the news and Wall Street. Price doesn't get near my stop loss. My stop's going to be below this to this line, and price rallies nicely out of that demand zone, comes back, tests it again, and then takes off. And where does it go to? It rallies all the way up to the supply zone. Now what's going to happen when we get to the supply zone? Well, we're going to get more signals from Wall Street once we get to the supply zone, and they're going to probably look something like this. Oh, now we're in third quarter of 2015. Microsoft's had a good quarter, so the news is very positive. Analysts are now going to give it an upgrade once we get up near the supply zone, and the trend is up. So what signals are the novices getting now? Well, the signals from the professionals is that you ought to be buying. You ought to be chasing this momentum. We've got a breakout trade. What a wonderful opportunity to get on board. Look at all this wonderful confirmation we've received. And what do you think is going to happen? Well, I'm going to show you what's going to happen. This is not really the time to buy, chase price into a retail price level, because this is a supply zone. Now, how do I know this is a supply zone? Well, I identified this way back in November, that this is a supply zone, and if and when we were to have a retracement back to the supply zone, this would be that there's a bunch of unfilled orders of institutional sellers that miss this initial move to the supply zone originally, and when price finally gets back to that supply zone, these institutions are going to get into action and become net sellers, even in the face of all that wonderful news, and we see price fall away. How many times have you seen a company come with great news, analyst upgrade, and the stock does not perform well at all? As a matter of fact, it may go sideways for a tad and then collapse in price. And you sit there scratching your head wondering, what happened? Well, I'll tell you what happened. What happened was that the news came as price was entering a well-defined OTA supply zone. That's what happened, and it ran into the headwind of a bunch of institutional sellers that are queued up to get out of their trade. Ladies and gentlemen, determining the high probability turning point in the market is best utilized by using the Online Trading Academy core strategy to determine high probability turning points in the market. And remember what these supply and demand zones are that we pre-identify every day in the market with multiple asset classes. And we trade them, by the way, both in futures, derivatives, and in exchange-traded funds. They're very, very powerful, and they are far superior in defining high probability turning points than traditional technical analysis. Now, if one wants to fine-tune these supply and demand zones with a little bit of technical indicators suggested like Bollinger Bands, we have found that Bollinger Bands work remarkably well in combination as what we might call an odds enhancer to the core strategy of the proper identification of the supply and demand zone. So let me go forward here and go into a couple of our trading rooms and show you exactly how we're going to draw these zones. In order for me to, I'm going to give you a short tutorial. Obviously, don't take the information you're getting from my webinar today and try to go out and identify these zones on your own. There is a very rigid rule-based formula we follow. I would encourage you to come to our free workshops that are hosted both online and at tradingacademy.com, virtually all over the world. And we've also got a full-blown center there in St. Albans, and we would encourage you. We occasionally host them in the metropolitan area of London, and we also hold them in 40 other locations across the world. So let's talk about how to identify and draw these lines. What we're looking for is the origin of the move, and the origin of the move for us is we're looking for where's there evidence that supply and demand is out of balance. So if I don't have these two lines, basically when I see price going sideways, I know that as it relates to order flow, supply and demand are in equilibrium. And I know that the buyers and sellers are shaking hands and the trades are clearing. The evidence of that is what the candles represent. But what I'm looking for is where is supply and demand out of balance? And I want to see a big imbalance. The bigger the imbalance, the better. Well, the evidence I'm looking for there are the length of the candles. Long expanded range candles, either red or green, is giving me evidence that one party is overwhelming the other. If it's a red candle, I know the sellers are overwhelming the buyers. And if it's a green candle, I know the buyers are overwhelming the sellers. So what happens in this example on the left is three big red candles appear, drive price down to a price level where more buyers appear. And when the more buyers appear, supply and demand comes back into equilibrium. How do I know that supply and demands come back into equilibrium? We'll take a look at the yellow area on the bottom of this chart. Price has gone sideways again. price has gone sideways. Now, this could be any increment of time. These could be 1 minute candles, 5 minute candles, 1 day candles, 1 hour, 1 month candles, 1 year candles. It really doesn't make a difference. It just makes the difference to identify in what period of time are supply and demand in equilibrium, and in what period of time are prices not at equilibrium. So price goes sideways for a period of time at a lower price, and then all of a sudden the buyers and sellers get a little more frisky, and we get a retracement of price right back up to the supply zone here at the top. And what happens there? Well, notice on this particular move, on the first retest back to the supply zone after this bottom, the price doesn't go very deep into the zone. Matter of fact, this is quite common. If you've drawn those two lines in the right location in the supply zone, you're going to discover that when you get the first retest, that price doesn't go deep into the zone. Look at all the open area here. Price goes sideways a little bit, and then a big red candle drives price right back down to the demand zone. Why didn't price go deeper into that zone? Well, our analysis is this. When price initially left that supply zone here on the left and collapsed in price, everybody who wanted to sell did not get their order filled. So there are orphan unfilled orders of sellers left in that supply zone. They did not want to miss that trade because these are institutions that either as a principal or on an agency basis need to get all their orders filled in order to get their full commission or to get their full trade on. That being said, they don't really need price to go deep into that zone. They're going to go ahead and start selling as soon as they get to their target price, which apparently they did, which immediately we saw sellers overwhelm buyers as evidenced by that big red candle, and we get a retracement back to the demand zone. Notice we have two choices here. We can be a short seller on the first test of the supply zone, or we don't want to be a short seller. We can just wait for the lowest risk, highest probability trade, which is to buy this demand zone on the first retest back to the demand zone. But regardless of where I take it, either short in the supply zone or the demand zone, I'm going to put my stop below the distal line of my trade. We didn't even in either case get close to our stop. Price rallies beautifully out of the demand zone. Why? Because there's unfilled orders of institutional buyers that are orphans left in that demand zone waiting patiently for price to get back to the level where they prefer to take a buying action. Let's take a look at a couple of other trades. I want to show you a couple of trades out of our trade room. This is one where we offer various trade rooms. We host about 10 of them that are segregated by asset class of specialty. So we have a room for investors, we have a room for day traders, we have a room for swing traders, we have a room for options, currencies, futures, equities. We have multiple rooms depending upon which component of the capital structure you would like to trade. You want to be a bond trader? Great. We've got ways to trade bonds if that's what you want to specialize in. It really doesn't make a difference to us. In this particular case, we were looking to go long Walgreens boots. We had identified before the market opened where to draw our two proximal and distal lines to identify our demand zone. Now I'm going to take this and blow it up here on the right. Price drops right back down into our demand zone. So this nice movement here out of this demand zone in the origin of the move has moved price up to a premium, and we felt there was a high probability that price was going to come back, retest this demand zone. So we use our robotics to enter a trade before the market opens, waiting for the retest back to the demand zone, where we're going to be a buyer upon price automatically touching this proximal line. We're going to put our stop below the distal line, which means that the two lines represent our risk on this trade, and by adjusting our share size, we can get our risk very, very small. In this particular trade, Our proximal line was at $80.51, and our distal line was $80.51. Our proximal line was $80.76. So we're risking on an $80 stock 25 cents. So we're keeping our stops very, very tight. And if we've drawn these lines in the right location, we do get a high probability turning point, as you can see in this particular trade, with a very small amount of risk. Beautiful trade. Let's take a look at another one. We know that the behavior of the novice is to be a seller in fear as you see this price declining on Walmart boots. But to the trained online training academy graduate, that tells us we need to be the other side of that novice fearful response, because there's a high probability of a whole bunch of unfilled orders left in this demand zone that missed the original trade when we saw this rally coming out of the demand zone, which gave us the cue to draw these two proximal and distal lines forward in time for our trade setup. Unfortunately, the novice has a history and a track record of repeatedly buying after a decline in price, and we as online training academy graduates want to get them out of their pain, and we'll go ahead and buy the shares from them if they really would like to get out of the trade. Let's take another look at another trade in one of our trading rooms, and then we'll kind of call it a day, I guess. My hour is about up, unless you have any questions. And this is the QQQs that we had set up on a 60-minute candle. We generally post these for our graduates before the market opens. Oops, in this particular case. And in this particular case, we were looking for price to come down, hit our demand zone, which we had identified at 135.77 to 135.96. So there's about 20 cents risk on this transaction on $135. You can see we're using very, very tight stops. I love the use of tight stops. Let me get back to that one. I'm sorry. And we go ahead and buy on the entry to the proximal line. We put our stop below the distal line, and we get a beautiful rally out of that zone. This was all set up before the market even opens each day for all the major indexes, the Dow, the S&P, the Russell, the Qs. So that's kind of my talk for the day. I would encourage all of you to come to Online Trading Academy's website. Come to enjoy some of our power trading workshops. We'll go into a lot more detail, and I hope to see you in one of our rooms one day. God bless you all. Good luck. I hope all your trades are green.
John, thank you very much indeed for that. Tradingacademy.com is the link, and I've just posted that in the chat box there.
Great.
One or two questions, which I think we've just got would take a minute to look at. Richard was just commenting on from earlier in your presentation, saying that the fees from mutual funds are stated between 1.25%, 1.5% in the UK.
Well, that's good. Your fees are approximately, your fees in the UK then are about half of our fees. Matter of fact, some of the most expensive fees in the world on mutual funds I've discovered are in Canada. They're even more expensive than the US.
Well, he does say that actually in practice they're more like 2 to 2.5%. So it's a little bit more than stated.
Oh, by the way, the exchange traded funds that we use are 1/10 to 1/20th of the fees that are charged on mutual funds, either in the US or the UK. So the most efficient mechanism to trade, if you're going to use a basket of currencies or ETFs, are to use the ETFs to trade on the New York Stock Exchange. They're by far more efficient than mutual funds. Check them out.
The interim advanced decline slide is of which instrument? You mentioned the interim advanced decline.
Oh, what do you mean, the instrument of advanced decline? I don't know what you mean. Yeah. I don't understand the question.
Okay, we'll come back to that. And finally, Andy said, doesn't the demand change throughout the day? Again, we're going back
yes,
about 20 minutes.
of course the demand. Not only does demand change during the day, but supply changes during the day, and the ebb and flow of the change of supply and demand is reflected at different price levels. At the end of the day, but you have to recognize that institutions, when an institution gets an order at a given price level, and they're given an order by, say, an insurance company that would like to buy 500,000 shares, what makes you think they're going to be able to go out and get their complete order filled at that given price? Because maybe they'll get a partial fill. Institutions get partial fills all the time. But the institution who's the intermediary for the order is going to wait for price. This price is going to move up and down during the day. But the institution is patiently going to wait for price to come back to that level where the client gave them an order to buy. And the client's going to say, look, I want to buy 500,000 shares. And they give them a little bit of wiggle room on what the average fill per share is. So institutional behavior is much different than retail behavior.
Wow, I think we'll probably finish on with Christopher's comment where he says novice traders lack confidence and institutional traders don't trade with their own money. So
well, some of them do. I mean, Goldman Sachs, UBS, they act as principals. They do both. They both act as an agency and they act as principals. They do both. Now, we can debate on any given day or any given week what % of their transactions are acting as principals and what % of their transaction is an agency trade. But they have a responsibility to a client to get the order filled at the most attractive price.
Indeed. John, we'll have to wrap it up there. I've got another speaker waiting. But again, thank you very much for joining us on the Round the Clock Trading event. It's been great to have you, and we will keep in touch. And good luck with everything that's going on at Trading Academy, Online Trading Academy, and good luck with that big event in Las Vegas. Hopefully, I'll make it across next year. That'd be nice.
Well, I want you to come next year. I think you'll have a great time.
Thank you, John. Speak to you soon.
Okay.